So we're going to be looking at what we call a business-to-business transaction. We often refer to it as B2B, the B2B business-to-business transaction. Again, that's when one business sells stuff to another business. Okay, so that's really what we're going to be looking at. Learning objective 2 looks at this transaction from the buyer's perspective, the business that's buying the inventory. Learning objective 3 looks at the same thing from the seller's perspective, the business that's selling. Okay. One thing you have to know is how to read an invoice. So this is really going to mean everything to you here. Remember, in accounting, we have these source documents, and an invoice is a source document. From this source, we do the accounting. So here we have the name at the very top here, PW Audio Supply. They're over in Michigan. Usually it's their invoice, so they would be the seller. On the side here, you have a little list of who they sold it to. So in this case, this company Sock Stereo from Illinois is the buyer. Okay, so PW Audio is the seller. Sock Stereo is the buyer in this business-to-business transaction. A few things that are very important as well. The date, right? When did this transaction occur? Why is that important? Because both the buyer and the seller have to do accounting on this. Okay, this is going to be recorded in the journal, which you're going to be learning. Okay, so it's very, very important to understand that. Another thing that's really important to understand is that they sold inventory. So this business, PW Audio, owns this inventory, but they just sold it to Sock Stereo. Okay, what did they sell to Sock Stereo? They sold a circuit board, one circuit board for $2,300, it looks like. And it looks like they sold 5 circuits, $300 a piece, $1,500. So they just sold $3,800 worth of their inventory. Again, PW Audio owns it. They're selling it to Sock Stereo. So they just sold $3,800 of their inventory to Sock Stereo. Other things that are important to know. This is going to be a bill. This is going to be a bill to Sock Stereo. Sock Stereo is going to get a box in the mail because, again, it's being shipped from Michigan to Illinois. And they're going to get a box with the circuit board and these circuits in it and this invoice, meaning this invoice becomes a bill that Sock Stereo has to pay. Okay, so that's what this invoice means to Sock Stereo. Again, the invoice is going to mean something different to PW, right, which we'll get to in objective 3. Another thing that's really important is because that's a bill, when Sock Stereo opens the box, they're going to get their circuit board and circuits, and they're going to get this bill. When do they owe it? Well, that's what the terms are for. Okay, these are very common terms of payment of the bill. 210 net 30 is how we would read it. The first part here, 210, simply means that if they pay within 10 days, they get 2% off. That's the 2% in 10. 10 days from what? The date on the invoice. That's the important date here. Okay, so if they pay within 10 days, they can take 2%, which means they pay 2% less of this total if they pay early. If not, the net amount, which is whatever's left, and is due in 30 days. Okay, so those are the terms. Another thing that's very important to know is when is this circuit board and circuits, when does Sock Stereo own them, right? Because PW Audio has them now, they're selling them to Sock Stereo. So when does the ownership of this circuit board and circuits transfer from PW Audio over to Sock Stereo? Well, that's what this FOB box will tell us. FOB, freight on board, it's an older term, but it simply tells us when the ownership of this transfers to the buyer. Sock Stereo takes ownership at the shipping point. What does that mean? Well, again, this company, PW Audio, is in Michigan. They're going to put the circuit board and these circuits in a box with this invoice and give it to a shipping company. That's the shipping point. At that point, and it could be a UPS, could be a FedEx, could be whatever. At the point they give the box to the shipping company, Sock Stereo owns it. Okay, it's no longer PW Audio's stuff. It is now Sock Stereo stuff. Okay, so very important to know how to read an invoice. Okay, if there's any questions, you can chime in, but this is important. So we are going to look at things from Sock Stereo. Again, when you look at this chapter, you have to figure out what shoes you're in, which means you're looking at the transaction from whose perspective. So here you're working for Sock Stereo and you're looking at this. So how do we prepare the journal entry for this purchase? Okay, well, again, important to know the date is going to be noted in the journal as May 4th. And what did we just buy? Well, we just bought a whole bunch of inventory. So this is going to be a debit to inventory for $3,800. But this invoice represents a bill that has to be paid. So we're going to credit accounts payable for $3,800. So just for the purchase of the inventory itself, that's how Sock Stereo, remember, Sock Stereo is the buyer here. This is how the buyer is going to record it on their records, on their books. This is a good explanation of when ownership of the good passes from seller to the buyer. We've already discussed FOB shipping point, but I kind of like this graphic. Okay, so let me explain the graphic. This the seller is PW Audio. They put it in a box, right, along with the invoice. As soon as they give it to the carrying company, whoever it is, that's when the ownership goes to the buyer. So in this case, the buyer owns this inventory, even though it still is on a truck or a plane or whatever and has to get to their store. Remember, they're going, in this case, from Michigan, Illinois. It's not across the street. Okay. So again, Sock Stereo owns it, even though they don't physically have the goods yet because it's in freight. So because they own it, they're going to be paying for all the freight. They're going to pay for the shipping and insurance on that to make sure it's all set because they own it. It's their stuff. The other option, and this is the most common one right here. The other option is called FOB destination. And again, that's when the goods arrive at the destination, that's when the ownership transfers. So if we were to do an FOB destination, again, our seller is PW Audio. They would put it in a box. They would put it on a shipping company. That shipping company would go all the way from Michigan to Illinois. And then when it got to the destination where the buyer is, that's when the ownership transfers to Sock Stereo, which means when it's in a box and when it's in transit, it's still owned by the seller. It's still owned. That's their inventory. So they're going to pay for the shipping and the insurance because that's still their property. Okay. So that's the difference between shipping point and destination. It still talks about when ownership goes from the seller to the buyer. Again, at shipping point versus at destination. So I think it's relatively easy to figure that out. All right. So how do they handle it on the books? Sock Stereo, if Sock Stereo pays for the freight charges, what do they do? And it costs $150. How does it look on the books of Sock Stereo? Well, this is one of the interesting things about assets. Assets, we have to list the asset as to what it cost us. Okay. So for example, if you bought something for $10 and you had to pay another $2 for shipping, and I asked you, hey, how much was that product that you just bought? If you were an accountant, you would say $12. because that was the true cost. It was $10 plus $2. So the total cost was 12. You probably wouldn't answer it that way. It's 10 bucks. You didn't even include the shipping. Well, in accounting, we have to value the asset for everything. So if we're paying $150 more for our inventory costs $150 more. So Salk Stereo would simply debit the additional $150 into their inventory account, because again, inventory is an asset account and we have to value it accurately. Historical cost principle, among other types of things that are in play here. Again, these are the rules of GAAP that I'm teaching. We would simply credit cash because we would simply pay the freight. Okay. So that's how Salk Stereo would look at it. FOB shipping. What if PW Audio decided that it was going to be FOB destination and it was their stuff to pay? Well, the seller looks at it as an expense. So they would expense it as freight out. There's another expense account that you've been introduced to here. Freight out is simply an expense account. You would debit the expense, credit cash. That's if the seller was paying the freight charges, which would be the case for FOB destination. You know what it's like to get a box of stuff in the mail, right? You might have bought something from Amazon or some other thing. You open it up, it's not really quite what I wanted. If you're dissatisfied for any particular reason, what do you usually do? Well, you usually return it. Well, that happens in business too. So again, Salk Stereo opens the box, looks at the circuit board, looks at all these circuits, and decides, I think I bought too many circuits. I want to return one. Well, that's a purchase return. This is very common. This is very, very common. It happens all the time. What's a little less common, but still happens, is something called a purchase allowance, which means, let's say it was two different companies. Let's say Lids got a bunch of hats from a manufacturer, and they opened the box, and the hats weren't exactly what they were hoping to get. But they think they could still sell the hats, just not at the price they thought they would. So they would say, look, I'll keep these hats if you give me an allowance. In other words, give me a discount on the purchase price and I'll keep them. Otherwise, I'm going to return them. And so that might happen on occasion. And if that's the case, it's a purchase allowance. But that's basically what these things are. How does it work in actual accounting? You're simply returning merchandise. You're simply returning inventory. So if they return $300 worth of inventory to PW Audio on the 8th of May, we would simply reverse out what we did earlier. We would debit our accounts payable and credit our inventory because we're literally sending inventory back and we're not paying for it. So we lower the liability, we lower the payable because we're not paying, and we lower the inventory because we just gave the inventory back. So on the buyer's part, it's actually quite easy to do a return. I think it'll be a little bit tricky on the seller's part later on. Everything affects inventory. So remember, the buyer was given, Salk Stereo was given an invoice with an option to pay early, right? If they paid early, they'd get a discount, right? 2% discount if paid in 10 days. If not, the whole thing is due in 30 days. This is very common because the seller is going to collect their cash early. That's the whole idea of giving the discount. I want my cash now. And if you give me my cash now, I'll give you the discount. The purchaser, the buyer here, saves money because in essence, they're going to pay less for their inventory. Okay. So, so this happens quite a bit. And so how would it look? Well, the most common discount period is 210 net 30. You can also have a bunch of others as 110 net 30, 215 net 45. There's a whole bunch of them there, but this is the most common one that's being used in the book. That's the one you'll see the most. Oops. So let's assume here that Salk Stereo pays in that 10-day period. So they have to pay by the 14th, and they do. They only owe $3,500 now, right? Because they bought $3,100 worth of stuff, but they sent back 300. So that's $3,500. That's how much they owe. But if they pay before the 14th, they owe 2% less of that, or 98% of that amount. So how would the journal entry look on Salk Stereo's books? Again, they're the buyer. Well, the first thing they would do is they would say that their accounts payable has been paid. So they would debit accounts payable. They would cut a check for $3,430. The $70 discount means the inventory cost less. Again, this is where the historical cost principle and GAAP come into play. When you pay less for your inventory, you have to show that your inventory costs less. Okay, so the credit to inventory simply means on the books, you pay less for your inventory. And this is what it is for a buyer. When they buy stuff, they add the shipping, but they take away, they subtract out the discount on any purchase. The value of the inventory account is the most important thing to a buyer. Okay, so that's why everything is revolving around inventory, because it is really about inventory. If they paid on time in the 30 days without taking the discount, they'd simply pay the full amount in cash, no problem. Okay, inventory would not be affected. So learning objective 2 ends with a transaction that's you're going to see it in both 2 and 3 between two companies, De La Hoya and Juno Diaz Company. So first happens on the 5th of September. I know Cinco de Mayo is a big day, but Cinco de September is good too, okay, accordingly. So De La Hoya buys merchandise on account. Again, that little phrase there, on account, means they're getting a bill. They're getting a bill. They're getting that invoice. They paid $1,500 for it. So that's what's happening on the 5th. 3 days later, they return goods for $200. So let's journal that. Well, on the 5th, they bought the inventory. So that's easy. You debit inventory, credit accounts payable. That's easy. On the 8th, they returned it. So you flip it. You debit accounts payable for the amount that you returned, credit inventory for the amount that you returned. And that's the deal on the buyer's end. So as promised, we are on the other side of the transaction. Learning objective 3 looks at this whole thing from the seller's perspective. So we're going to be doing the books for PW Audio. Now remember here, what's important is you did sell, you've made a sale to another company. So you certainly have that, but you sold one of your assets to another business. You sold your inventory. And as inventory gets sold, it becomes expensed as cost of goods sold. So there's actually two things that are happening on the seller's side. They are making a sale, so they're earning revenue, right? They have sales revenue. But they also are, they have to cost out, they have to expense the inventory that they just sold. So two things are going to happen to the seller. The very first thing that happens is they record the sale. So whatever the selling price is, they're going to debit the accounts receivable and credit sales revenue if they've given them an invoice. And a lot of business-to-business transactions are on account. So this is pretty common. However, if the business is paying cash for that, then that's a debit to cash and a credit to sales revenue. Yeah, that's for the selling price, whatever they sold it for. The second thing they have to do is record the fact that they don't have that inventory anymore, right? So they have to cost out their inventory. They do that by debiting cost of goods sold. Remember, cost of goods sold is an expense account. Inventory gets a credit. Inventory is the asset account. Once this asset gets sold, it gets expensed. Inventory eventually turns to cost of goods sold when you're selling it, okay? So that's very important too. So look, two things are going to happen. And of course, the cost to the business is going to be different than the selling price. You're going to sell it for a lot more, as much as you can. So these numbers are going to be different. And that's another thing you got to pay attention to. They give you the number. So here's the illustration. PW Audio needs to record the sale. Remember, they sold $3,800 worth of goods to Sock Stereo on the 4th of May. However, the cost to PW is $2,400. So they sold literally $2,400 of their inventory for $3,800 on May 4th. So again, they got to record the sale. So they debit the accounts receivable, credit sales revenue, and then they got to record the cost of that sale. Cost of goods sold for $2,400. That's this other number here. Inventory credit $2,400 because they sold $2,400 worth of inventory. Okay. That's important to know. That's important to know. So the flip side of getting boxes returned to you, to the seller, they need to know, they need to keep track of what's being returned to them because they're not in business to sell stuff just to have it come back to them. Okay, they want to sell it and not see it again. They want the customer to keep it clearly. So when stuff starts getting returned, they keep track of it separately. All right. So sales returns and allowances is actually a real name of a revenue account. But this revenue account has a debit balance. So it's a contra revenue account. So it's a revenue account with a debit balance. It shows literally solely the returns and allowances. Okay. You're not going to touch sales revenue because you sold it. You are going to note that certain things were returned. Okay. It's very important for companies to find out what's being returned because if things keep being returned, you might not want to sell that product. It seems to be upsetting to your customers if they have to continue to return it. So that's important to know what inventory you should have in the store because your job is to sell it, not get it back. Right. So very important to do that. So remember, returns happen all the time and returns happen for a lot of reasons. So here, PW Audio got that $300 of returned goods. That was a circuit that was returned to them. Now, it's very important to know two things. One, that circuit cost them $140, although they sold it for $300. And can they sell it to another company? Well, if it's not defective, yes. So it's important to note, and that's the assumption here, that the good was not defective, that it wasn't returned because it was defective. It was just returned because they didn't need it or didn't want it or whatever, right? Other reason. So they can sell it to another company should they want it. So what does it look like here on the books of PW Audio? Well, they're going to debit their sales returns and allowances for the $300 and reduce the receivable because they're not going to receive any money on that sale, right? That part of the sale. So that's all set. Now they got to put it back in the inventory. That's what the cost is for, right? They're going to debit their inventory account by $140, and they need to reverse out the cost of goods sold. So the cost of goods sold account, even though it's an expense account, it's a bit of a different type of expense account because it's very, very busy on both sides. Usually expenses are only busy on the debit side until you close them with a credit. Cost of goods sold, you will see a significant amount of activity on the credit side of the account as things get returned and put back into inventory. The cost of goods sold has to be adjusted as well. And again, it's only for goods that are not defective that you could put in the full cost of it and resell it. Sometimes, and it's a very rare thing today, that goods products are defective for a number of reasons. I mean, when I was your age, about 5% of the products were roughly defective. And so we went back to the store a bit more often than we wanted to. Today, thanks to computer-aided manufacturing, the robotics, and just the technology that we have that makes much of our goods, The defection rate is well below 1%. It's a fraction of 1%. So this doesn't happen to a lot of people that it happens. And of course, it depends on the product. If the product is a simple product and it's made well, probably no defections. But as the product becomes more complex, like electric vehicle, has a lot of parts in it, then chances go up that there's going to be something defective with it. But nonetheless, that's that. If you have a defective part, you're going to create a scrap value for it on your books. I wouldn't use 50 bucks. I would use an odd number like 9, something that's going to stick out. That's different than all the other costs, because that'll identify that particular good as defective, and we're unable to resell it. We will send that back to the manufacturer, or, if we are the manufacturer, we will be replacing it. So the PW Audio would need to make a similar entry. They would debit their sales returns and allowances and credit accounts receivable. That doesn't change. What would change is the value they would put into their inventory. They would put in the scrap value back in the inventory, and they would credit the cost of goods sold for that same scrap value, so they can identify it in their records as literally defective. Thankfully, it doesn't happen a lot. All right, remember we gave Sock Stereo a chance to pay us early and get a discount. All right, so sales discounts is a real account. It's another revenue account, but it's a contra revenue account. In other words, the balance is on the debit side. And that's important. So every time a company pays us early and takes the discount, the difference is going to go into the sales discount account. And it's important to know this particular chart that's here. This is going to be a very, very important thing to know of how companies actually calculate their net sales. They'll take the full sales revenue, right? That's the total amount they've actually sold. They'll subtract out the returns and allowances, and they'll subtract out the sales discounts. Net sales is the account you will see on, I would say, every income statement for any merchandiser that you look up on the internet for their financial statements, and you look at their income statement. You're not going to see sales revenue. You're going to see net sales. And if you see net sales, it's gone through this process. They started at sales revenue, they subtracted out sales returns and allowances, they subtracted out sales discounts to get to net sales. You have to know that. This is something you have to know, this process. Boom, 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 and boom. Boom, boom, boom. So, Sock Stereo pays early, which means they are paying with a discount. They paid early. They paid on May 4th, 14th. So that's in a 10-day period of time. So PW Audio is receiving a smaller check because they allowed a discount. So how does it show up on PW Audio's books? Well, first thing they're going to do is they're going to show that they received $3,430 in cash. Okay. They're also going to show a debit to sales discounts, because that was the sales discount for this. And of course, they're going to show that their entire receivable has been received. So they'll credit the receivables account, and that particular account is satisfied. So this is how the selling company looks at things. Back to our example between De La Hoya and Juno Diaz. De La Hoya was the buyer, Juno Diaz is the seller. So we're going to be doing the books of Juno Diaz in this. So on the 5th of September, De La Hoya buys merchandise on account from Juno Diaz. The selling price is $1,500. The cost was $800. 3 days later, on September the 8th, De La Hoya returned the goods worth $200. It had a cost of $50. So first things first. Let's find out how we would record in our journal for the 5th of September when they made the sale. Remember, any seller has to do 2 steps. They have to record the sale, and then they have to record the cost of the sale. So the first thing that happens is we're going to debit accounts receivable for 1,500, credit sales revenue for 1,500. But again, we just sold them $800 of our merchandise, so we're going to need to debit the cost of goods sold for 800 and credit inventory for 800. So all of this would happen to show the record of what on the 5th of September, okay, for who no dias. 3 days later, they return goods. These goods are not defective, so they can sell them again. Okay, so they return $200 worth of goods at a cost of $105. So sales, returns, and allowances will get the $200 debit. Accounts receivable, $200 credit, right? We lower the receivable because we're not going to receive money on that. Okay, and we put it back in our inventory. So we're going to debit our inventory account for 105, credit our cost of goods sold for 105. And that's how a seller would handle it. Questions on that?